setting this up, one of the things that you wanted to talk about, which was the infinite banking concept, and we could talk about misrepresentation on that all day long, but
oh yeah,
you were mentioning something about high frequency borrowing. Can you elaborate on that? What the dangers were? I think you're talking about the dangers to the company.
So I'll give you some real life experience. I have a client here in Chicago whose family was in banking. They since sold the bank, but they were in banking for 80 some years. And the older brother was on the board of directors of Mutual Trust. And my family goes back with this family all the way back to the Great Depression. We had banked with them, and the bank were clients of mine. The brothers and the family are clients of mine. And the older brother comes to me. He's on the board of directors of Mutual Trust. He goes, "John, can you help us out? I need you to sign an NCNDA, and I want to bring you out to the offices in Oak Brook." So I signed the non-circumvention, non-disclosure agreement. I went to, and it's since expired, so I can share this. I went out to Mutual Trust in Oak Brook, Illinois, which is the town I grew up in. And I was confronted by not only the chairman and the CEO. They wanted to know why their lapse ratio was so high. And I said, it's real easy. Looking at your balance sheet here, the amount of policy loans you have relative to reserves is too high. LIMRA studies indicate 97% of all policy loans are never repaid. And it's not just LIMRA, it's basic economics. People don't like to repay loans. They don't, which is why people are generally debt averse. You know, I'm right now, I'm at the University of Chicago getting an advanced degree in behavioral economics. And we are talking about that very same thing in class, although we do the class on the internet, which is a drag. But at any rate, that was one anecdote. The other anecdote comes from Nelson Nash's brother-in-law himself. And his brother-in-law, David Steens or Stearns or whatever his name was, says to me at one time, "Don't tell Nelson, but I don't repay my loans." And Nelson even copped to the fact that in the original text of Infinite Banking, his book, Becoming Your Own Banker, that his illustrations were woefully out of date. All that having been said, the concept of high frequency borrowing, which we generically refer to in the industry as infinite banking, is incredibly dangerous to insurance companies. Because when a properly designed IBC policy is going to have a lot more paid up ads than it is hard premium, probably 2 to 1 or 3 to 1. And ALIR or PUA or OPP, every company has a different acronym for, additional paid up ads. Those monies can't be invested in reserves because they don't know when the redemptions or the withdrawals are going to occur. I've been very fortunate to be taught by some great actuaries in this business, both from Guardian, where I started, and Mass Mutual, where I am now, and Bobby Samuelson, who I think is the smartest guy in the life insurance business, about how this stuff really works and how it's built. And there's no magic to life insurance. It's the time value of money. The insurance company pays claims out of cash flow. They don't pay claims out of reserves. Reserves are the last money they ever want to hit. The reserves are there in case they go BK so they can make good on the contractual obligations. This doesn't mean that borrowing from your life insurance is wrong. It's there, the cash values are there, and the loan provision is there as a benefit to the policyholder. However, when it comes to infinite banking, actually when it comes to finance in general, and in my practice, I consult on a lot of M&A work and a lot of private placement work, so I am intimate with this. The cheapest source of funds is always your best bet. I've got a couple of billion in face, and most of my clients are closely held businesses or highly compensated professionals, attorneys, doctors, etc., there's not a one of them that I don't slap a third party cash value line of credit on their policies, because those are loans at very favorable rates, LIBOR plus a margin, and they don't hit your credit report.
Right.
Infinite bank your butt away off that, but leave the cash value with the company. The cash value is the collateral for the death benefit. And in truth, the cash value is nothing more than the net present value of the death benefit at the reserve rate.
Mm-hmm.
Don't believe me? Take out your HP 12-1C and take out a ledger and do the math. At least the guaranteed cash value's got to stay there. Paid up ads are a little bit different because that's the insurance company's gift to you. So it's not that I'm against infinite banking. What I'm against is the ubiquitousness of it and the proliferation of it to largely unsophisticated consumers. You know, one of the biggest misnomers in infinite banking is you're paying yourself back. No, you're not. Read your life insurance contract. You own the contract. The insurance company owns the equity. You own the contract. The equity is merely a representation of what you paid in and what they gave back to you. So when you borrow from the insurance company at 5 or 6, you're paying rent on somebody else's money. That's what interest is. And it's not accurate to deduct the dividends or interest credit against the loan rate. They're uncorrelated. But that doesn't mean you can't borrow. Look, I borrow all the time. And I still use the car analogy when driving policy loan.
You cut out there a bit, John. But what I was going to mention was that a lot of times, in whether it's whole life or indexed universal life, however they're promoting infinite banking with whatever policy, but often they'll say, well, you're paying yourself back. And as you said, no, you're not. You're paying the insurance company back. It's the insurance company's money, and they get to charge a usury rate of that interest. And sometimes they say, well, you get that interest credited back to you. But the dividends being credited is not correlated to the interest you paid. It is not a direct thing. It's kind of like, well, if you're going to pay an interest to a bank, but you happen to own stock in that bank, that whatever you're paying as a dividend doesn't mean that you're getting your interest back.
Right, exactly. Yeah. Interest is rent paid on money. I would advise everybody, or I would recommend everybody on this call, read Henry Hazlitt's Economics in One Lesson.
I will have to go get for that on Amazon and make sure we promote that.
Yeah, or even a basic book on money and banking.
Yeah. Absolutely. Tom, do you have any thoughts on what John has said? I'm sure we're pretty much in agreement on all that, but
Oh, absolutely. I think your comment, John, about an unsophisticated consumer.
Yeah.
I would argue that it started with the seller. Yeah.
Well, yeah, no question agent about that. Yeah.
And I think our industry does such a crappy job of explaining how stuff works. Life insurance will sell itself all day, every day. It's what we do with it that has a tendency to kind of muddy the water.
Yep.
I'm on a mission the older I get, and I really do want to give back to the industry the basics. I want to get back to, I believe if we were trained, all of us were trained differently on how to be our own person and why we do what we do, I think we would all be top of the table producers, and we'd all have a much healthier life. But man, I'm part of David's life insurance agent discussion group, and I see some of the conversations that go, and I'm constantly vomiting in my mouth and being so adamant about not just getting on the damn keyboard and going, where in the hell do you live? And let me know where you are so I never meet you.
It's terrible.
Oh, it's horrible. Absolutely horrible.
You're absolutely right. That going back to Bob Castellone, we could vilify him at all different levels, and because we've all had bad experiences with him, but we also had really great experiences with him. And that was ultimately when he set out, his point was to educate. And having grown up in a family business in manufacturing, and we distributed our products through manufacturers' reps. So it really wasn't dissimilar to the life insurance industry, because life insurance companies distribute their product through manufacturers' reps. We just call them agents. The life insurance company is a manufacturer. They really don't have any stake in the outcome, because here's a dirty little secret of the life insurance business. And this was shared to me by a couple of lobbyists whose names I will not divulge, and a couple of home office executives from a couple of companies whose names I will not divulge. The 3-year lapse rate on life insurance is in excess of 30%. So the insurance company, knowing that that's true, and knowing that they need cash flow called premiums to keep their enterprise afloat, is continually focusing on the new and better product, the new and better product, the new and better product. And agents go running to it. The market for life insurance hasn't changed in over 50 years. So what does that mean? That means most of the sales occurring in the industry are replacements. It's going from one company to the next. It's not expanding the marketplace.
And our industry still has a two-faced attitude. We will still give the new agent who brings over all of the business that's already been expensed 4 times, give them brand new accolades and trophies.
Yep.
And if that person were to do the same thing with the company they're with, they're terminated for cause.
Yeah.
So you've got an industry that can't even police itself, trying to beat the system. Oh my God.
Wow. Yeah. I mean, we've got to separate ourselves. And I think you'll agree with this, Tom, that the RIA space does it a lot better than the insurance space.
What's that? The RIA?
Yeah, the Registered Investment Advisory, the independents, the independent registered investment advisory space handles the development of their advisors much better than we do.
I remember at a Mutual of New York convention when I first started my career, they had a sales psychologist come up and speak, and he said, "You guys are so lucky, because the minute that Merrill Lynch begins to learn this is all about relationships and not transactions, every one of you are unemployed."
Yep. I have a friend of mine whose daughter went to the University of Wisconsin that has a tremendous personal financial planning program that culminates in a CFP qualification. And she took her first job, and she's at Merrill Lynch. Merrill Lynch advisors are taught, and usually when a new advisor comes into Merrill Lynch, they're assigned a team. They either stay with that team or they evolve and grow and spin out of that team. Their first 3 years is about 50% of their workload is studying in excess of the CFP content and learning prospecting. They are not allowed to cold call. They are not allowed to direct mail. It's workshops, referrals, and LinkedIn. That's it.
Yeah. David Barry wants to ask a question. I think he's got his hand raised.
I want to make sure we got to Barry's question. Barry, what's on your mind, brother?
Hey guys, hey John, and now I know how to. I'm just going to say Ouija board from now on when I read your name, and I think I'm going to get really close.
My business cards are actually a Ouija board.
Oh, I love it. I love it. Spot on. Hey, going back to your commentary on loans and interest rates, I just a quick comment and then 2 questions. One, I have to say that just the whole idea, just the language of infinite banking and bank on yourself. I think just the language itself is so fundamentally flawed. The person who's receiving the interest is the bank, and that's the life insurance company. And so I even see people who are teaching, quote, infinite banking, bank on yourself type strategies. And I see the comments from the people supposedly that they've trained, and they're still saying, oh, you're going to, instead of paying the bank, you'll pay yourself. That's just not true. It's just completely inaccurate.
You know where that came from? You know where that came from? Pamela Yellen. Pamela Yellen's an information marketer. Maybe 20 years ago, she hooked up with Nelson, and, you know, she was, you know, a disciple of Dan Kennedy in magnetic marketing. And she wrote the book Bank on Yourself. She bought a shitload. Oops, sorry, didn't mean to say that. She bought a bunch of time on time brokered radio and on Sirius and satellite radio, selling her commercials, set up a call center offshore, started selling territories to licensed life insurance agents, and was mass marketing.
The agents don't know any better because they're just repeating her drivel.
Yeah.
I knew Pamela way back when she was, you know, she was a wholesaler hawking annuities. So, you know, everybody passed, right?
I used to do seminars with her on Dan, because I was a Dan Kennedy disciple myself. So I mean, I go back with her too.
I've been paying Dan Kennedy for 40 years.
Okay, so you know, it works. Yeah. Lumpy mail still works.
I love lumpy mail so much. So here's my question. So I encourage people to during we'll just call it accumulation phase, distribution phase for common language. So I encourage people when they want to borrow, repay, borrow, repay, borrow, repay, and then the last loan that they don't repay is we'll call it the retirement distribution loan.
Yeah.
The other piece of this is I try to encourage them to say, well, yes, you could borrow from your policy and, you know, still have, you know, avoid the opportunity cost if you're buying a car, but that's a depreciating asset. If you can, it would be really nice if you use the loans for appreciating assets where you're not at risk, like real estate and things like that. That's really using it, you know, I think really effectively. I think the last point is, and this is one I've struggled with because I really want to be accurate in my language and representation. And one of the things you said, John, really kind of hit me was, if I have my loan rate in one ledger, because it's a completely separate transaction from whatever my policy is being credited in another ledger, is it fair, I'll just say linguistically, to say that because I used to say that therefore your net borrowing cost is X, or if it's even a wash, zero. And I'm like, well, they don't technically net against each other.
No,
maybe in the air somewhere, but not in real life.
No, they don't, because remember, a dividend is a return of unused premium. A dividend early on is mostly unused premium. It doesn't turn into excess, and it doesn't turn into more excess earnings until about after year 15. Now, however, the revisions to Section 7702, which were the biggest godsend Congress could have given the life insurance industry, and to Tom's point, we should all be knocking down $1 million of premium a year with the new products.
Yay, lobbyists.
Yeah, no, they did a great job, and I'm going to give props. One of the people we all owe is Allison Weiss, head of government relations at Mass Mutual. She was a pit bull, because the original proposal that Congress was going to give us was reserve rates set at the AFR, which would have been a long-term disaster.
Yeah,
and now we've got reserve rates at 2%.
And thank Richie Neal too.
Yeah, absolutely.
Yeah, because he knew all about 7702.
Yep, absolutely.
If I have a policy that, let's just say, I'm going to try to use it. I'll use two numerical examples. Let's say the loan. I'm trying to think of it. Well, let's even just use a wash loan just to make it really, really clean and clear. If my credit on if my charge rate on my loan and my credit on my policy are the same, I just feel like when people borrow, I always say, look, you figure out how much you're going to borrow, pick a term, you know, HP12C stuff, pick an interest rate at least equal to the rate charged by the life insurance company or greater, and then come up with your own little amortization schedule on that simple interest loan. and then pay it
Yeah.
back, because you'd have
But
to pay it.
remember, if you're going to charge a rate higher than the insurance company, most of what you're paying back is just your PUA, because you can't put more money into a contract beyond the hard premium or the schedule premium.
The schedule
And there's a
period.
dirty little secret about PUAs or OPP or ALIR or whatever the hell, your giving company wants to call it. About 7% of that premium is load.
Yeah, the old premium loads are, but if you're doing a loan repayment and you actually designate it as a loan repayment, doesn't it bypass the load on a regular premium payment?
No, because I remember being on the product committee at Mass, and we had a use it or lose it paid up additions rider. And I said, that's really dumb, because Guardian, Northwestern, New York Life, they all have stop and go and you don't lose it. And what I was told and then brought into the lab and shown the math was that there's a cost to the stop and go, because the insurance company, like any other financial institution, needs consistent premium flow. And paid up addition riders aren't guaranteed. So they have to insure against anti-selection. That's why that extra load is in there. Now, we wound up doing it for market forces. We had to do it, but it's expensive.
Yeah. And then this could be a John question or a Tom question or both. I have my own explanation, but I don't want to influence your answers. If someone asks you about a premium load, I have a list of things that I represent that, these are the expenses an insurance company incurs and deals with that. But I just want to say, how do you guys respond to the premium load question? And by the way, I do current assumption ULs or IULs as well as whole life. So, it's kind of across the spectrum of those products and handled a little differently. But how do you address that if someone asks, if it's in the illustration?
Yeah, go ahead, Tom.
Okay, so we're going back to the beginning of time when the only product available was term. And the people said, you know what, I don't want to have to keep paying an increased premium. So let's come up with a level premium. So we'll take all the expenses out at the beginning to offset the costs that will be happening the older I get. So for those people that wanted coverage at the time of death, term insurance was never the answer. There was a level premium term insurance contract that they called whole life. So the loads are completely different. IUL is a pay as you go. Whole life is pay up front. Term is pay as you go.
Yep.
So when somebody wants to get into the nickels and the dimes and the quarters, I won't go there. It has nothing to do with what we're trying to accomplish. Nothing to do it. And when you buy your automobile, do you want to look at the timing belt and when the spark plug is actually igniting the fuel, or do you just want to get the damn car, turn the key and go somewhere? So there's a lot of things under the hood that you could learn all about, but I don't think that's really part of the conversation. If you want to do that, I'll get you a book. There's 13,000 of them written about all of this.
I agree. I mean, I think there's the black box of it all.
Well, Don Blanton would say jokingly, you want to know where that first year's cash value went? Want to go see my new car?
Yeah, but that's actually not true though, because the load, I cannot share this. I like to joke that I'm beyond getting fired from Mass Mutual. I probably am, but this would probably do it. I actually have on my hard drive, given to me a couple of years ago from the chief pricing actuary, an unbundled life insurance policy, everything line itemed out. The bulk of the first year premium does not go to comms. It goes to reserves.
Reserves.
The first 7 years go to reserves. The comms are paid by existing premium coming into the company. just like the death benefit is. And Tom's 100% right in what he said. Here's a good analogy that I say. I go, you ever buy a new car? Yeah. Are you concerned about the wholesale price of steel? Because the price of the car that you're going to buy is not set by BMW or Mercedes or Audi or Chevy or Tesla. It's set by the market. The wholesale price of steel affects all car manufacturers. And there is a point at which they might all have to raise prices because their raw material costs went up. No different with life insurance.
That was fantastic. Barry, was that good for you? That was great to me.
Sorry, trying to back myself to unmute. Yeah, that was great. It's I just have a lot of respect for the time in the saddle that these two gentlemen have had, and I thought that's one of the ones that I've just always I know it goes to a lot of things, and it's just but sometimes people will. I hate the fact that it even says load, it's compared to kind of mutual fund language. But yeah, that was very helpful. Thanks, guys. I got to drop off, but
Barry, let me give you one comment before you take off. My largest sale, the doctor looked at me and said, "I hope you make a fortune."
Yeah.
And the reason is because nobody is out there talking like the way you're talking. The people who don't want to buy what you're asking them to buy are the people that are concerned about the cost, what I could have done with something else, and they'll bitch the rest of your life.
Well, look at all the money saving them in taxes and money not lost, and
they don't see that
negative market returns. Let they add all that up and compare it to that front end.
No, they won't go there. They won't go there. So when you have a conversation that's building on what are you going to make? Where's this load going? Is this your car payment? Is this I go, you know what? We're just not a good fit. We're not a good fit, and walk away.
Yeah.
By the way, those are the clients that will call you at 4 o'clock on a Friday, and you look at your caller ID and go, oh shit, it's you. Right. So when you can understand, you get to choose who you get to work with. And all of us need to do a better job of vetting. Remember, I started this whole day by telling you, I go around the country giving people permission to fire clients. Fire them. If they don't believe as you do, get rid of them. This guy that's asking these types of questions does not believe what you believe. So just be careful. I'm not saying don't take the client, because I've been in a contest. I've been late on a mortgage payment. I get it. But if we're taking it for the wrong reason, man, it will come back to bite you in the butt. It will.
Always, man, always.